that the markets are more powerful than any central bank. This is very, very bad. You have rising front end and a rising back end. You have a bond market that is losing credibility. You have a bond market and an economy that is losing liquidity. It's not as deep as it once was thought to be. And so I think when we talk about what could happen, yeah, I think we're going to see a lot of problems as it pertains to rates, to the banking system, to the economy.
In today's episode, Andy Schectman shares his insights and experiences with the commodities markets. Andy, the CEO of Miles Franklin, highlighted a significant shift in the gold and silver landscape. Despite rising global interest rates, gold continues to exhibit strength, serving as a safe haven amid global economic challenges like burgeoning debts and a sluggish economy. Geopolitical tensions and escalating concerns about financial stability are fueling the demand for gold, positioning it as insurance against a decade of extensive borrowing. Interestingly, while there's a noticeable uptick in gold sales, silver remains a sought-after asset for those cognizant of its role in hedging against chaos and uncertainty. The interview also delves into the impact of divisive issues in the United States, apprehensions about an impending economic downturn, and the evolving global financial paradigm, underscored by the introduction of a blockchain-based payment system named BRICS Pay. Like, subscribe and turn on notifications, as everything helps with the algorithm, and check our pinned comment if you're into crypto to get the best sign-up bonuses in the market. Let's get into the video.
Or and whatnot, but that is not the cause of inflation. Inflation is an increase in the money supply. Let's talk about some of the things happening in BRICS. Again, little by little by little by little, we keep seeing. We recently see Russia and Sudan have recently agreed to build a joint naval base in order to establish a Russian presence near the Suez Canal. Well, I mean, look, you have Egypt and Iran, United Arab Emirates, Saudi Arabia, all these countries in that area, all part of the BRICS now. And now you're beginning to see military presence along with the BRICS naval alliance that was designed to patrol the Indian Ocean. These are trends that are growing little by little by little. You have the head of South Africa, the president Ramaphosa, said the future for critical minerals in Africa is very bright. The era of giving away our raw materials is over. And they seek to ensure that the lion's share of the wealth created by turning our raw materials into high-value products stays on the continent. You are going to see very likely a nationalization of assets, of mines, of minerals, of the rights that the West has traditionally come in and done this in a coercive manner. You are beginning to see countries like China go in and industrialize places like Africa and South America in a cooperative manner to help bring these to the marketplace and not at the sole benefit of the West, but a cooperative benefit of both parties.
Now, Andy talks about the current state of the de-dollarization and the creation of a digital currency by the BRICS nations.
We see Malaysia actively exploring the gold dinar as a potential new reserve currency for Malaysia. The prime minister of Malaysia just came out a few days ago and said if we can get between only 5 and 6% with Islamic countries using the dinar, it would be a positive start as it provides strength and reduces the dependency on the U.S. dollar little by little by little by little by little. This is what we are seeing. We're seeing all of these countries strike deals in their local currencies. They were all tasked, their finance ministers, going back to the drawing board, coming back in 24 with ideas on a common settlement currency. It will come. We talked a lot about Brazil and China doing this deal at corn a few months ago, where Brazil is the second largest exporter of corn in the world, signed a deal with China to sell them whatever they sell them, they'll accept payment in yuan, and China would accept payment in real. And now it's gone past corn. The export sales of U.S. soybeans have decreased by over 40% compared to the same period last year because the largest importer, which is China, has turned to Brazil and are buying Brazilian soybeans instead of U.S. soybeans, little by little by little by little. China came out, there was a report in Reuters last week, actually 2 days ago, October 22nd, wants to deepen oil and gas cooperation with Gulf countries and seek potential for cooperation in the new energy vehicle industry, such as power batteries and smart charging piles. So, look, all of the rare earth minerals, most of them are found in the Eurasian continent. President Widodo of Indonesia, who's an OPEC country, said, yeah, we need to create an OPEC-style cartel for rare earth metals as well. Not thinking this out very well. You're seeing de-dollarization little by little by little. The Shanghai Petroleum and Natural Gas Exchange just the other day settled its first cross-border transaction in digital yuan. So they've done several transactions for oil settlement and natural gas settlement domestically, but this is the first one they did overseas. Now, they didn't tell us who the counterparty was, but that counterparty accepted digital yuan. It's the first cross-party deal they have ever done, which is interesting.
Gold remained steady on Friday, poised for its second consecutive weekly gain, buoyed by a weakening U.S. dollar and growing market confidence that the Federal Reserve had concluded its interest rate hikes. As of 02:05 GMT, spot gold stood at $1,992.46 per ounce, with a 0.7% rise for the week, while U.S. gold futures hovered around $1,993.40. The decline in the dollar index by 0.2% against its peers, heading for a second weekly dip, made gold more affordable for holders of other currencies. Despite a slight increase in the benchmark U.S. 10-year Treasury yields to 4.4568%, diminishing expectations of Fed rate cuts in 2024 supported gold's upward trajectory. The recent stronger than expected jobs data did little to alter the perception of a slowing U.S. labor market amid higher rates. The Fed's cautious approach, as indicated in the minutes, has introduced a market disconnect between expectations for rates and the central bank's stance, contributing to some hesitation in gold prices. Now we'll show you more clips of Andy Schectman, but first, subscribe and turn on notifications to let us know that you like the video, and check our pinned comment as Bybit gives you free $20 just for creating an account in their crypto exchange so you can start testing their regulated platform for free. Let's get into the video.
In other words, they're saying there's going to be problems, spillover. There will be systemic problems. And Powell himself said that the geopolitical tensions pose important risks to the global economic activity and carry highly uncertain implications, and warned of increased volatility and the likelihood of a significant economic slowdown as credit dries up. You hear a lot of people talking about the money supply drying up, and it is. You're seeing M2 drop at a level that we've never seen before. We're seeing the repo market being drained of its liquidity as all of this money is in search of yield, most of it going directly to the Treasury. Places like treasurydirect.gov, we see tons of money leaving, the regional banks going into the money markets, and much of the money that it was in the reverse repo market, a lot of it being the money market funds, are now leaving the repo market facility altogether and going right to the Treasury, which that repo market facility is the lifeblood of many corporations who need liquidity. And it's drying up like we saw in 2019. And so we are going to experience, I believe, great stresses in the system. And, they talk about this uninversion of the yield curve, usually being the time when the recession shows itself. We've seen a greatly inverted yield curve for a very long time, which means that you get paid a higher rate on short-term treasuries than on long-term treasuries. That's inverse of how it's supposed to work. Well, the idea behind that is that, the traders don't like what they see out in the future, and they believe the Fed will have to shrink interest rates down in the future to accommodate for bad economic conditions. So that's normally the case, where the Fed comes in and lowers short-term rates in order to uninvert the curve. But instead, what we are seeing, I think, is the realization that the markets are more powerful than any central bank. And the fact that we see massive dumping of the long end of the curve on the 10-year and the 30-year Treasury, where the rates just aren't high enough to attract anybody. And so what you are seeing as those bonds are sold off, rates rise higher on the back end of the curve instead of the Fed lowering the front end. This is very, very bad. You have rising front end and a rising back end. You have a bond market that is losing credibility. You have a bond market and an economy that is losing liquidity. It's not as deep as it once was thought to be. And so I think when we talk about what could happen, yeah, I think we're going to see a lot of problems as it pertains to rates, to the banking system, to the economy. And the spillover, as Powell wants to call it, I think is something that is not to be taken very lightly. Quite to the contrary. I think we'll see rates much, much, much higher. And I think it's just beginning.
What do you think of today's episode? Are the BRICS nation going to destroy the U.S. dollar, as Andy says? Will all this geopolitical tensions translate into higher gold and silver prices? Post in the comments section down below your honest opinion. Share this video with someone who hates platinum and subscribe to the channel to let us know you enjoyed the video. Thanks for watching till the end, and I see you next time.